Today, we'll be talking about a very important topic. Last week, I had a call from this guy who told me he bought a 7-unit apartment building last year. And he has come to find out that the house had some issues. And he's not making the money he was supposed to be making in that house. So I had an appointment with him. We met and I asked him some key questions. And probably when he was buying that house, he did not do his due diligence. I talked to him and told him what he was supposed to have been doing before buying the house. And that's what inspired me to do this video today. You never know who this can touch. Today we're talking about how to buy small apartment building for beginners. Whenever you're buying a 1 to 4 unit, it is considered single family. Whenever you're buying 5 units and up, it is considered commercial residential real estate. So it's commercial residential. A 7-unit apartment complex falls under commercial residential. He bought this 7-unit apartment building with a customer mindset. And what do I mean when I talk about a customer mindset? A lot of times, most of us want to get into real estate investing. But the most important thing about real estate investing is for you to have the right mindset. We make the mistake of approaching real estate investing with a customer mindset. What is a customer mindset? It's about the cost. How much will this house cost me? Affordability. Given my credit and my assets, will I be able to afford this? Or how much can I afford? How much is the sales price? And how can that fit into my budget and my other expenses? This is the typical mind of a customer mindset. When you're buying a 1 to 4 unit, which is considered single family. What is the mindset of a real estate investor? Real estate investing is all about finding properties, either fixing them up, and then making money from these properties. So a real estate investor is an entrepreneur. They have an entrepreneur mindset. And an entrepreneur focuses on benefits and not on cost or affordability. It's all about the benefits. A real estate investor has 3 ways to make money. Number 1, cash flow. What will be my cash flow? If I buy this apartment complex, this 7-unit apartment complex for $200,000, what will be my cash flow after my expenses? Number 2, building equity and appreciation. How, based on the statistics in this area, how much has homes in this area appreciated over the past 5 years? And what is the prediction? What is the predictive appreciation value in the next 5 years? That's what a real estate investor looks at. If I am to sell this property tomorrow, how much will I make from selling this property? Another key benefit is what? The tax benefits. The tax laws favors real estate investors because everything you do as real estate investing is a tax write-off. You can deed this property to your children. And this is how you can also build generational wealth. This is the mindset of a real estate investor. What the guy who talked to me did, he approached the real estate investing with a customer mindset. And that's how he ended having a bad deal. He did not do his due diligence as a real estate investor. Whenever you're buying 5 units and up, it is considered commercial, residential real estate. And here are some due diligence you must do if you want to succeed. The first thing, ask for what we call the T12. The T12 is the trailing documents. And it's T12 because it's for 12 months. The T12 will have the income statements. It will have the repair invoices. It will have the payroll. It will have the data for the apartment management company if there was one. It will have your occupancy ratio. It will also have what we call rent rolls. Rent rolls will actually tell you how the tenants are paying rent. Are they late in paying rent? Are they paying on time? Ever buy an apartment, a small apartment complex, without asking for the T12, for the trailing documents, from the seller? If the seller is not willing to provide you with the T12, the trailing documents, do not buy it. It's not a good deal. If they did not keep track of their records, do not buy it. Back out. They are no good business people. And this is what happened. This is what happened to the guy who called me. There was no T12. He bought it out of what? Out of emotion. They told him the 7 unit all have tenants, 100% occupancy ratio. That is good. But he did not ask, how long has that ratio been? And what are the rent rules? And what kind of tenants are there? Number 2, as an investor, the first thing you want to guarantee is the fact that you'll be able to make money. And once you get your T12, your trailing documents, then you'll be able to calculate your net operating income. Net operating income will be your rental income minus the expenses for that building. Let's take an example. The rental income for 1 year is 100,000. Your expenses is 50,000. So your NOI, your net operating income, is 50,000 per year. They just told him we have 100% occupancy ratio, and he was excited about that. That is a typical customer mindset. That's why he failed. The most important verbiage you will hear in commercial real estate is what they call the capitalization rate. If there's any one thing you have to memorize as a residential real estate investor or as a commercial real estate investor, is what we call the cap rate. And what is the cap rate? The cap rate is your net operating income divided by the sales price for the building. So when I asked him, what was your cap rate? He said, what was cap rate? He didn't know. Right there you could tell already he made the wrong decisions. So let's say, for example, we already have our net operating income here as 50,000. Let's say the price of the house is 500,000. So in this case, we have our NOI as 50,000. Let's say, for example, the sales price is 500,000. To get our cap rate, we'll divide 50,000 by 500,000, which will give us a 0.1, which is equals to 10% cap rate. 10% cap rate in the investment world is very good. Now, depending on the market where you are, you have to know the market, because real estate is all about the demographics. It's all about where you find yourself. The same cap rate you get in Manhattan will not be the same cap rate you get, somewhere in Wichita, Kansas. It's the most important thing for you to understand your market. But a cap rate, to me, what I've seen in the market, between 7 and 10 is a good cap rate. Sometimes you may go down to 6, but like I say, it depends on the market. That's why you must do your due diligence. You must understand the market in which you're buying. That's one important factor. I will do a video on that. That will be another video, understanding the market in which for you to invest in real estate. But a cap rate, of 7 to 10%, 10% is a very good cap rate. Why is the cap rate important? The cap rate is important because it helps you determine the profitability of the building you're buying. As an investor, it's all about your margin. It's all about your profit margin. The cap rate will help you determine that. Another great question I'm asking: how did you determine the value of the 7 units you bought? How were you sure that the sales price, the house was not overpriced? He told me, they showed him the tax record. The tax record gives you an idea of how that property is being evaluated by the county for tax purposes. It does not necessarily give you the real value of the property. That's why you have to do something called a comparative market analysis to determine the value. So, in determining the value, the net operating income, so we already have our net operating income in this case, is 50,000, divided by our cap rate. Our cap rate is what? Our cap rate is 10%. So this will give you $500,000. So in our previous example, where the house was selling for 500,000, you can walk back to find out the value, to know if the house is being overpriced or underpriced. And it's simple: your net operating income by your cap rate. So this helps you to do what? This helps you to make an offer to the seller. You must know the value. As an investor, you should be able to come up with a value to help you make an informed offer on that building. Because it's all about what's going in as your investment and what is coming out as your profit. Another key issue here is cash on cash. Very important. The return on your investment. This is at the heart of you making an investment decision, because this will determine how long it will take for you to actually break even. To determine your cash on cash return will be your annual cash flow divided by your down payment. Let's say, for example, your annual cash flow is $10,000 and you put in 50,000 as your down payment. In this case, we 0.2, and you express that in percentage, it will be 20%. So it would take you 5 years for you to break even. Your annual cash flow is $10,000 divided by your down payment. So by the time you go to year 5, you must have breaking even. So that's when you can say, let me maybe pull out that down payment from here and invest in another property. It's very important to understand your cash on cash ratio. So if each year is 20%, in 5 years, you'll get to 100%. This is how you invest as a real estate investor with data. I'll go back to my opening. Most of us make the mistake. We approach real estate investing with a customer mindset. We focus on the cost and not on the benefits. And if you want to focus on the benefits, you need real data. Real estate investment is very, very rewarding, but you must do your due diligence. C2C mentors, and all we do here, we talk about your finances, we talk about real estate because we understand it is at the foundation for your family's success. Thank you, do your due diligence, and see you on our next video.